Hello, I'm Jonathan Noyes, Head of Investment Research at Wealth Club, and today I'm with Paul Davidson from Octopus Ventures to talk about the Octopus Apollo VCT. Hello Paul, welcome back to the studio. So we're here to talk about the Octopus Apollo VCT. Should we start with that? What is it? What does it aim to do?
Thank you, Jonathan. Great to be here today. So I'm Paul Davidson. I'm a partner here at Octopus Ventures. I'm also the lead fund manager for Octopus Apollo VCT. My role involves finding great companies to invest into, then actually making the investments themselves, and then working with those businesses to support their growth and development to hopefully achieve an exit event in the future. The Octopus Apollo VCT is a VCT that sits within the Octopus Ventures business. It's part of the broader Octopus Ventures group. And Octopus is one of the largest investors in VCTs across the UK. It's been doing it for over 20 years, and the mission of the business is to invest in the people, the ideas, and the industries that will change the world for the better. Now, Apollo itself has been investing, as I said, for almost 20 years. The fund is approximately $500 million in terms of AUM, and there are around about 50 portfolio companies that sit within the fund today. The main mandate of Apollo is to deliver a 5% dividend yield on the net asset value per share, with the opportunity for capital appreciation over the life of your investment in the fund.
So Paul, what sort of companies does the VCT back?
Yeah, so Apollo is mainly focused on B2B software companies. These businesses tend to have at least or around about £1 million of revenue or annual recurring revenue. And what's quite critical is that these businesses have already got a commercialized proposition. So Apollo itself is not investing into kind of pure play startups. We're not taking that product level risk of a business that maybe doesn't necessarily have product market fit. So our capital is really going in to invest in these commercialized propositions where the capital is being used for investments in internationalization or further development of an existing product or platform that the business may have, or indeed investing in their go-to-market engine. So typically these companies have a requirement for around about £2 to £50 million of growth capital. And Apollo is really looking for businesses that are operating, I would say, at the more mature end of the early stage ecosystem. So these are still, early companies and still have all the inherent risks involved in early stage investing, but they tend to have a slightly lower risk profile in terms of their development or bringing a product to market, which is really, really important for the fund. Because I think, as opposed to traditional venture portfolios, what we've tried to do with Apollo versus others, where you're really looking for a small number of outlier returns to drive the majority of the fund's performance, Apollo is really seeking to invest in a broad variety of companies that can all deliver decent returns for the fund that allows it to achieve a more consistent or ideally lower volatility set of returns, which it benefits from investing in these types of businesses.
And typically these companies then, they're generating maybe a couple million or more of revenue?
Yeah, so they're generally around about £1 million of revenue. We have other companies that will have in excess of that. There could be £5 or even £10 million of revenue on entry. There is quite a good spread across the portfolio, but one thing that they are generally not is pure play startups.
And there's been some rule changes recently to VCTs, some positives with a little bit of a sting in the tail. What are your initial thoughts on these changes?
Yeah, I mean, look, I think for a VCT like Apollo, which is around about $500 million, these rule changes actually help us in many ways, because we've always wanted to invest for longer into some of these companies and to really drive very successful UK scale-up stories. And because of the inherent limitations in those limits previously, we've been prevented from doing that. There's a number of companies in the portfolio where we would love to invest more money, and these changes in the limits, moving for knowledge-intensive companies, the annual investment limit from 10 to 20, and the lifetime from 20 to 40, really create a big opportunity there for us. However, I think on the flip side, the government's current decision to change the relief on VCTs from 30% to 20%, I think will have a counteracting effect. And, that is something that is a little bit disappointing to see, because I think, we're trying to support this ecosystem and the innovation economy. One of the things the UK economy is missing is probably, a lot of UK scale-up stage stories. So, I think the relief changes inhibits that slightly.
And so turning to the portfolio, any examples of companies you've been backing recently?
Yeah, so there's a few to mention. We're often looking for companies that operate in quite resilient end markets, businesses that have good contracted recurring revenues, across the base. And there's a number of examples within our portfolio with companies that have those characteristics. One example is a recent investment called Threatmark. And Threatmark is a business that operates in the cybersecurity space. They have a behavioral fraud prevention platform, and they sell that into the financial services sector, so mainly banks. And why we like Threatmark's platform is because once it's being sold to a bank, the bank is then using it to evaluate any potential scams or social engineering issues that might be happening across their customer base. It can be monitored across lots of different digital banking platforms. So if you bank online or using your mobile, Threatmark's solution is effectively scanning all of your user behavior and activity. And it's trying to stop fraud before the transaction actually happens. So a lot of traditional fraud monitoring solutions, only happen after the payment has been made. What Threatmark is trying to do is trying to predict a hacker or an account takeover or a scam before the transactions actually has been made. So it saves banks a lot of money. So that's one investment that we made over the last 12 months. Another investment we made is in a company called Definely, and Definely operates in the legal services space. It's a business we invested into around 24 months ago. It's done really, really well with our investment. And that business was actually established from or by two ex-corporate lawyers, two ex-Magic Circle law firm corporate lawyers, and they really understood the challenges faced from lawyers in actually producing and developing legal documentation end to end. It's a very manual or labor-intensive task. This product actually produces, annotates, and reviews legal documentation at scale, creating a really seamless user experience. So that's a business which has also done really well for us, Jonathan.
Ah, very interesting. And then maybe turning to some of the more established holdings in the portfolio, maybe Natterbox being quite a large holding. How's Natterbox getting on?
Yeah, I mean, Natterbox I think has been a great success for the fund. Natterbox has been in the fund since approximately 2018. When we invested in that business, it was kind of sub 5 million revenue, and our capital has really helped it to scale to many multiples of that. The business is still seeing really good growth. It's operating in a very interesting space, which is the cloud telephony space. And what the product does, it tries to enrich the experience for a consumer when they call a customer contact center. So it helps to improve the customer support levels. It also helps to improve sales productivity levels. And that is a space which is seeing like huge digitalization and also adoption of artificial intelligence. So what we were actually seeing from Natterbox is them bringing out their own AI suite of tooling and products. And we think that's a really exciting opportunity for the company to continue its growth and success going forward.
Oh, very interesting. And it's probably, although you can't say where your future funding will go, but it's that sort of business that these rule changes are targeting, isn't it? These companies they've expanded internationally, they might need a little bit of extra capital. It's that type of.
Yeah, I'm not going to name names of particular companies, but Natterbox is at the larger end of our portfolio. It is in a scale-up stage situation, and it's companies of that style that I think will benefit from these rule changes.
Very interesting. And so turning to exits, you've had quite a large exit recently. Can you tell us about that, Paul?
We have, Jonathan. We've had a really nice exit of one of our older holdings. It was a business called Interact Software, or Hasgrove. And what Interact did, it provides intranet software for large corporate organizations. Business which we've had in the portfolio for over a decade, has done really, really well. And I'm delighted to say that we've recently exited that company in full to a private equity buyer. So, it was one of our largest holdings in the fund, and I think it's a really great example of VCT patient evergreen capital where, you're able to, hang on to these businesses for a lot longer than maybe a traditional LP GP fund structure would. So, an outcome that we're really pleased about. And actually, delivered a record money multiple for the fund.
I was just going to ask about the multiple.
Yeah, it's just over kind of 60 times money multiple, which is a fantastic outcome for Apollo. So something we're really pleased about. Obviously, no guarantees we can do that on every investment, but I would certainly love to be able to achieve those kind of outcomes.
And the exit environment in general, it does feel like it's picking up after a couple of years of being pretty quiet.
Yeah.
Are you seeing that at all?
Well, look, I don't think it's anywhere near as positive or as buoyant as it was, pre probably 2021, 2022. We are seeing, a small number of exits coming through. We had another exit actually earlier in the summer, which was a business called Pendula, and Pendula operated in the customer communications space. And we only had that holding in our fund for 2 years, and one of their existing customers acquired the business, which was a really good synergistic fit for that buyer and a really good home for Pendula. So that was a very rapid return of capital and recycling of capital for the VCT, and I think it's hopefully indicative of the market opening up a little bit and corporate buyers being slightly more open to M&A. I think one thing which is probably creating a bit of a bump in activity is more traditional technology companies or vendors that don't necessarily have new breed platforms or even an AI story or an AI narrative. They are highly acquisitive to try and develop that AI narrative, and that benefits some of our companies who are leading into AI or have AI products at their core.
I've heard that. It's interesting. And so anyway, we can't talk about exits without also talking about the risks, Paul. So for those who are looking at this VCT, how would you describe the risks?
Yeah, look, I think any early stage investment product is going to have the inherent risks of any early stage portfolio. These businesses are generally still loss making when we make the investment, and our investment is going in on the expectation that they will eventually become profitable and cash flow self-sufficient. That doesn't always happen. Sometimes these companies don't necessarily get to scale or get to maturity. But I think one thing that does help some of the risk profile is that the portfolio is fairly well diversified. So, you're not investing into a portfolio which has only got a small handful of assets. There are 50 companies that sit within the fund today, and we try and manage these businesses very carefully in terms of the funding and capital that they take on, which helps a little bit on the risk side. But of course, there is still losses, and there are still companies that will not necessarily get to profitability that may ultimately fail, unfortunately.
And so summing everything up, Paul, for those that want to back a VCT this year, why should they be looking to back the Apollo VCT?
Yeah, well, look, I mean, I'm a huge advocate of the venture capital trust market, of course, and I think it's quite unique being able to access a portfolio of early stage businesses, particularly in a mature fund like Apollo. And that's what Apollo is. I think it gives investors access to those really exciting high growth companies, but it does so in a way where you're getting access to a large portfolio of that. It's mature, and I think you've got an experienced team that's been managing that fund for nearly a decade now. And I also think you're getting access to a team which has a real specialism in investing in B2B software. And with everything that's happened in AI lately, I think we're a team that's really well positioned to take advantage of that through new investments and supporting our existing portfolio companies. So I think it's a great opportunity to get access to those types of businesses.
Paul Davidson of Octopus Ventures, thank you very much.
Thank you, Jonathan.
If you're watching on YouTube, please press like and subscribe to the channel for more.